With a big table there.
We're in, and first we say hi. So we'll say like hello everyone. We're the group 6 in management accounting COIL report, and we'll do the presentation now. So first up, I would like to invite Chi to do the introduction.
Hi everyone, my name is Chi and I will do the introduction. Okay, the president of Marathon Corporation, Max Pincus, our manufacturer of flash drive business, he has assigned our team clarify the data by streaming the projected profit, contribution margin, high-low method, and break-even point. Beyond that, the data provided by Pincus, it is clear to see that Marathon Corporation is not profiting and now require professional accounting and payroll service. And our goal is to have Marathon Corporation profit to increase because the profit fallen in the previous year. Our goal is to provide Marathon Corporation with professional opinions as to why the company has not been profiting, properly show and explain what the business should do in order to keep profit from the client based on the result from Word Excel, granted to have an asset map because with his corporation to keep the business running and give him feedback in order to do so. And next part is Michael.
So Michael, it's your turn.
Yep. Yeah, there's the slide.
No, you introduce yourself first and we'll show you the slide.
Oh, okay. My name's Michael, leader of the Melbourne team. Yeah. This is our This is our analysis and findings. Our cost classification shows that our total costs comes to a total of 2,110,000 over 115,000 units. Our variable cost be costing at $14 per unit. Our fixed cost came at a total of 500,000. Direct labor has the highest variable cost of $4.7 per unit. Our other factory overhead has the highest fixed cost of a total of $225,000. Yep, next.
Michael?
Yeah.
You should say something about the table. You can say that we divided our cost into fixed cost, variable cost, and mixed cost. And also are in category by production, selling expenses, and general expenses.
Yeah.
So that's how you divide it, and then you can come to the text next to it. Make sense?
Okay. What? Yeah.
Introduce the columns first, the 3 columns, the costs, and then the major classification: production, selling, and then general expenses. Right?
Yeah.
A clear picture.
Well, maybe you can just introduce what are the fixed costs and what are the variable costs are there.
Yeah, you can say that too. For example, fixed cost.
You can only say that what fixed costs do we have and what variable costs do we have, and that's it. And put something more like the highest variable or the highest fixed cost.
And also say about the mixed cost, the other factory
mixed cost. Yeah.
Mixed cost.
I'll be like in our fixed cost columns. We have sales, salaries, advertising. And then I'll be like our variable costs columns in our table.
Direct material, direct labor.
Yeah.
Then mixed cost we will have over other factory overhead. That one we calculate with high-low method. So that's all.
Okay.
All right, so we move on to Min.
So
To show your
hello
face.
everyone. This is me, and I'm at Melbourne, and I'm gonna take the calculation of the contribution part. So at first we need to calculate the project net income. So by assuming that the company will sell only 115,000 units at the sale price of $18 each, it will come to a sales revenue of 2,070,000. While we added up all the variable costs and the fixed costs, which come to $2,110,000, and in the end, the company won't make any income. We have a 40,000 of loss due to our expense higher than the sales revenue. I think so. The next step will be calculating margin calculation. Um, so by using the table above, using the table of the net income, the contribution margin is calculated by taking the sales, take away the variable cost, which will have the amount of the leftover revenue, which is available to cover the fixed cost, $460,000, and margin per unit at $4. The contribution margin at $4, which tell us that every unit sold by the company, and $4 will be added to the contribution margin, as well as the net income. And later on, we have the contribution margin ratio, which is by taking the contribution margin in dollar, divide the sales revenue, which will give us 22.22%, which means that 22% of the revenue available to cover the company fixed costs. And we have the break-even points the break-even point in units and dollar. We at 125 units and a sales revenue of $2,250,000. That's the break-even point for the company which required so that the company won't make any loss in the future. Is that good? Or no? Oh, yeah,
Yep. Can you speak up a bit because it's quite small? Your mic is quite small.
Okay.
Try to speak up and like project
Wait,
your
let me
voice.
try this. Wait, let me. Me? Can you guys still hear me?
Yeah. It's now.
Wait. I will try again with a sentence, and you guys can have it. Can see if it's okay. So I try one more sentence. The contribution margin calculated by sales revenue minus variable cost. Is that enough? Is that loud enough?
Yeah. It's okay.
Okay.
All right. Let's move on to Uyên.
Hello everybody. My name is Uyên from Vietnam campus. So the next questions is about the target income. The next question is about the target units of sales that Marathon Corp should sell in order to achieve the target income. So regarding the formula of sales quantity to achieve targeted pre-tax profit, we have the target income is $150,000. Total fixed cost is $500,000, and the contribution margin per unit, as we have calculated before, is $4. Working these figures to the formula, we can calculate the target sales quantity is 162,500 units. So the corporation have to sell at least that amount instead of 115,000 units like before. That makes the target sales revenue of $2,922,000. We have conducted a contribution margin income statement regarding the request. A contribution margin income statement is a superior form of presentation because the contribution margin clearly shows the amount available to cover fixed costs and generate a profit or loss. So here we have total revenue, which is total product sales minus the total variable cost of materials, labor, sales commission, advertising, and other factory overhead equals to contribution margin. So whether the contribution margin can cover all fixed costs are presented in the next slide. The next slide. The next slide. On my face. Here from the slide, we can witness the total fixed cost of $500,000 exists the contribution margin of $460,000. Therefore, the corporation is making a loss of $40,000, which means that the contribution margin cannot cover the fixed cost. To overcome the situation, there are some proposals. We have analyzed that the corporation may take a look. Let my partner Jung present the proposal to you.
Hello, I'm Trung, and I'm the leader of the Vietnam team. And next up, I will present about the suggestions to improve the profitability of the company. So first, the first scenario that the CEO of the corporation suggested us is to raise the sales salaries of the staff by 50%. So this will have a really positive impact on the net income. Actually, the most positive, which will result in a 30% increase in sales revenue, a 25% increase in total cost, which will ultimately result in 223% increase in net income. Also, when we look at the new indicators such as new contribution margin ratio, it will actually be higher than the original, which means that we will have a higher percentage of sales going into fixed costs. And also we have a higher break-even point, which means that we will have to increase the scale of the business, try to sell more to guarantee that we don't have a loss. Scenario 2, where we will be increasing the selling price by 15%. Now this will lower both sales revenue and total cost, but it will increase net income by 190%, which will result in $39,350 new net income, which is also profitable. And we have a higher contribution margin ratio. Actually, the highest will result from this one. And the new break-even point will actually decrease, meaning that we can reduce the business of scale or at the scale of the business while still making a profit. Scenario 3 will have raising simultaneously selling price, variable cost, fixed factory overhead, and advertising to contribute to both quality and price. So here we also have an increase in sales revenue, total cost, and a 124% increase in net income to 9,600, which is not as good as the other plans, but still saves us from making a loss. New contribution margin ratio will be 20%, and the new break-even point will also rise like scenario 1. Last scenario suggested is to redesign the packaging of the product, which will result in an increase in costs. And this actually is detrimental to the business because it will reduce the net income to minus 40,125 with a lower contribution margin ratio, but a higher break-even. So this plan is not recommended in the end. Next up, I will have Wan Lu, right?
Okay. Hello guys, my name is Wan Lee. I'm from Melbourne. The analysis used high-low methods to calculate mixed costs. The analysis was used to calculate contribution margin, break-even points, and target income. Lastly, several suggestions to increase profits were analyzed. The data shows that if Marathon Corporation maintained the original expected sales volume and sales price, it will not earn its target income and will lose money in 2019. Thus, Marathon Corporation has to sell more units to achieve the target income, or make some changes to cost or productivity. With different proposed plans, the selling price and expenses can change. Hence, sales and profits will shift accordingly. Based on the scenarios analyzed, there are some recommended plans for Marathon Corporation to choose. The first one is increasing sales salaries by 15%, which will encourage sales team and result in highest increase in profit. The second one is increasing product selling price by 50%. Although the sales decreases, the contribution margin per unit will increase, creating more net income. The third one is raising quality with 20% higher total variable cost, 10% higher fixed factory overhead, and doubling fixed advertising spending, while also raising price by $3. Then more people will know the product and the company will also profit. The last one, Marathon Corporation should not redesign the package of the product, which will increase fixed costs but insufficient revenue because this will result in a greater loss. The analysis tells us that to increase net income, the best way is to raise sales salary. Lastly, this can also be achieved by increasing product price or by boosting quality and advertising, albeit with less effectiveness. Yeah, that's it.
So thank you for listening. That's the end of our presentation.
Thank you for listening.